you can ask AI to, create me a co-founder agreement. It'll probably generate, a very good draft of something, but it's not going to ask you the questions that you don't know.
So many founders of early stage scaling CPG brands are thinking about things like shareholders agreements, co-founder agreements, raising investment, valuing their company. And often you don't know where to turn to find out the real stats, the real deets in terms of who's giving equity to who at what rate. How are people valuing their companies? How are people thinking about raising investments? How are people structuring their shareholder agreements and particularly their co-founder agreements? Well, I decided it was time that we got the lowdown. So I invited Phil Hales-Smith, one of the managing partners of Joelson, onto the show today to give us all of the lowdown, to try and lay it out for any of you out there who want to know not just the principles behind it, but the actual details of what best practice are, including the numbers. Let's dive in. Phil Hales-Smith from Joelson, welcome back to Brand Growth Heroes. How are you doing?
Hey, Fiona. Yeah, it's great to be back again, and very much looking forward to this chat.
Yeah, look, I asked you to come on because so many times I get asked by, whether it's people on Brand Growth Heroes Mini MBA, whether it's people who, you meet out and about, whether it's founders you're doing any D work for, how do I structure so many different deals when it comes to co-founder agreements, shareholder agreements, bringing on an advisor, raising investment? There's just so many different points along the different stages of each journey where you have to think about having a contract with somebody that it gives them security, gives you security, gives them equity potentially, and nobody really knows what the benchmarks are. And I thought we could deconstruct that together. What do you think?
Sure. Yeah, listen, delighted to. That's what I spend a lot of my life doing. So, yeah, I would be very happy to come dive in and sort of talk that through.
Amazing. Why don't we just spend 2 minutes telling everybody who may not have met you on the previous episode we did together, just tell everyone quickly, like what kind of things are you working on day to day? With whom?
We at Joelson here, I'm the managing partner, so I kind of run the corporate team here. We're really, really privileged that we kind of work with a whole range of different companies, a lot in the consumer space, and that covers, food and drink, health and wellness, beauty, a broad range of different sort of product categories.
Welcome to Brand Growth Heroes, the leading podcast for the founders of challenger grocery brands. I'm your host, Fiona Fitz. My 25 years at global giants such as Nestle and challenger brands such as Goo Chocolate Puds, Chobani and Strong Roots, as well as coach to over 400 scaling brands, means I have the experience to ask the questions that truly matter and get you the insight that will inspire you to think differently and drive serious growth for your brand. Throw some brands at us.
So some brands?
Throw some brands at us so everyone can drool.
Yeah, in the last couple of years, we've worked with Trip, we've worked with Beautiful Dairy, we've worked with Two Chicks. We've kind of been supporting a lot of your Brand Growth Heroes cohort, so all the aunties and people like that. It's kind of a huge cross section, and we're really lucky that we work with some of the greatest sort of founders and entrepreneurs in the consumer space, but from a really early stage. So what I love is kind of meeting founders who are thinking about an idea, and then how to actually kind of bring that idea into, well, what does a company look like? What does the founding team look like? How do I raise investment? What are the advisors that I need, and what are the commercial deals that sort of sit around all of that? And I think the value of, I suppose, that we bring is that we're really happy to start really early working with those founders, who before they've even set up a company, and then sort of taking it through, as they raise investment, as they kind of bring on their first employees, and then as they kind of bring investors on board. And then hopefully, in a few years' time, getting to a successful exit. That's, part of the thesis and part of what we've been doing for the last 27 years here at Joelson. And, it's something that I'm really happy to kind of share and talk about in terms of those kind of key principles and how we kind of work through that.
I think that's brilliant because so many people have, so there are founders out there who are really good at networking, are really good at asking the right questions, meeting the right people, and they've got some benchmarks around, how much equity to give at which stages and what a co-founder agreement should have. But then there are probably, 80% of people who don't have that network and who don't know that you can be cheeky and ask the right questions and kind of build up this little almost matrix in your head of what you need to consider at each stage and what that means in terms of conditions and terms and conditions and, what you're signing up to and what equity you're getting. And I'm sure it just feels like the Wild West for them. So I have to say it because I love this, just for anyone listening, actually, Joelson was the Phil and Paul, managing partners of Joelson, did the deal between Innocent and Coca-Cola, right? So that's how into this.
I mean, listen, before that, so one of the first deals as a very baby lawyer in 1999, Paul and I met the Innocent founders when they were doing their first fundraise. And so we did that transaction where they raised a grand total of £250,000, and they never raised any additional investment until they sold to Coca-Cola. So, that was probably the starting point for us focusing on working with founders and how you start, grow, and scale a business. Right? That sort of, and it was almost like us doing an MBA in terms of understanding how you create a business that kind of takes on the big players in the industry. And, we were learning, some of the marketing stuff they did was a bit, on the edge in terms of legal, and we learned, for us, it was a learning experience from, a high growth company that was super successful, but also they were learning from us. And so it's an amazing kind of, sort of experience that we've had, and then we've been able to bring that to a whole load of other consumer brands since then.
So will we start with, like, say you're somebody who is has started your consumer packaged goods, whether that's in food or beverage or in health and nutrition or wellness or household products or whatever it is. You could be a Purdy and Fig a few years ago, or you could be an Ancient and Brave, or you could be a Huel even, or you could just be jam. Will we start with either you've had the idea and you've worked it up and you've got the product and the prototype and you've maybe got your first listings and you want to bring on a co-founder? Is that the right place to start?
Yeah, so that you could start earlier. So you could start with, let's assume that it's two co-founders who are coming up with this idea, working out what their skill sets are, how they actually go to market, and then before you even start thinking about engaging with, how to, create the brand, what the trademark looks like, or the brand assets look like, or anything along those lines, it's like, well, you need to kind of set up a company. So, making sure that you've set up the right legal structure. And then sort of what is the deal between the co-founders, right? And what are the norms for that? How does that work? And I suppose, we touched on this last time we spoke, but, what's the fair thing in terms of the equity split? So who's getting what percentage between the co-founders, depending on the different contributions?
But how do you decide? How do you actually decide that? Because I thought, it's 50-50 or 60-40 or 70-30. Like, what makes that split fair? What are you considering?
Well, so you're considering, who's initially the driving force behind this business, right? Whose principal idea was it? What is the commitment going to be in the early phase of the business? There could be somebody who's quitting their job and starting full time, whilst the other co-founder sort of does it part time. That will dictate the proportion of equity that you get.
Yeah.
Later on, you can kind of look at sort of fixing that if you think there's an imbalance, if you're both working full time and you're both, sort of founding the business. But we'll come to that a bit later in terms of other things. Then the key thing is sort of kind of agreeing, well, actually, what happens if one of us leaves? Do you hold on to your equity? Do you have to give some of it back? Does some of it just, kind of automatically go back to the other co-founder? So those sorts of things, they're hard conversations to have.
So so let's talk about this, because I think we always talk about the principles in the industry. We talk about the principles, but we don't talk about how you actually make the decisions. So let's take an example. I'm the driving force behind the idea. I bring someone on quite early on, and we're both going to do the same amount of work on paper. That's what it looks like. And where do I start? 60-40? I mean, do you start with something that feels right? Does it come down to a feeling that where both people are happy?
Yeah, ultimately it has to be something that, you both feel is fair and equitable.
So how do you actually make that decision? I mean, is there a magic equation, or is it just about what feels right?
So there's no magic equation. I mean, it very much is, it's intuition, what feels fair and equitable between the co-founders, and also, what they're comfortable with. I mean, it's very rare that you get a pure 50-50 split, i.e. both people are kind of, we're fully in this to day one. So, 60-40, 70-30 is a very common split in terms of how that works through.
Well, that's the first metric for us to...
Yeah.
That's the first metric for us to realise, actually, that it's very rare that you get a 50-50 split.
Yeah.
There's usually somebody who is coming to the table looking for more because they were the one who was the driving force early doors.
Or they had the original idea, right?
They had the original idea. Okay, that's
or
brilliant.
They're the ones who started making the product at their kitchen table, and then they were like, oh, this is good. And then the co-founder sort of, there isn't a magic formula. But I think, there's obviously key factors that you will build into it, right?
Hey, just a quick word about Brand Growth Heroes partner, Joelson. So look, as a founder, you've got loads on your plate. Fundraising, shareholders, co-founders, co-manufacturing, product, NPD, you name it. Scaling is really complex, and the legal side of scaling can be really complex too. Who your legal partner is really matters, because it's not something we can afford to get wrong. That's why I work with Joelson. Joelson have worked with brands like Little Moons, Trip, Two Chicks, Grays, Costa Malika, and they've even advised the innocent founders on their sale to Coca-Cola. And they still work with them today at Jam Jar. And for me, it's not just that they're brilliant at what they do, but they're also really good people. They care about founders, they care about doing things properly, and that really matters. And they're also one of the few law firms that's both B Corp certified and a member of 1% for the Planet. Recently, I asked managing partner Paul Chappie, why does a scaling brand need a corporate lawyer?
So you definitely need someone that's going to have your back, that is going to be looking at those pitfalls that may be coming in the future, preferably someone that knows the industry, because having that context is really important when negotiating, be that commercial agreements or funding arrangements. And at the end of the day, you really need to have someone that you can trust and obviously can negotiate hard when they need to.
You're not going to believe this, but Joelson is actually offering a free legal consultation to any founders who listen to Brand Growth Heroes podcast. And I would definitely take them up on it. You'll find a link to book now directly here in the show notes below, or just drop a comment underneath the episode and I will connect you with them directly. And now let's get back to the show. So we often talk about this though, that there's like conceptually all the things that we need to consider at different stages, but actually how do you make the decision? So, how do you make decision whether someone gets 50-50, 60-40, 70-30? Is it just that you're feeling what's fair? Like, is there a magic equation?
There's definitely not a magic equation. So I mean, what I would say is it's very rare for it to be 50-50.
Okay.
Because everybody comes with, different contributions, and so it's usually based on, what people think is fair, what people commercially are comfortable with. And that's based on a number of factors. Is it whose idea was it in the first place? Who started making the product? Is the kind of kitchen table story. Whose kitchen table was it? Who was actually the person that actually came up with that idea? Those are the kind of key contributing factors. And then things like, if somebody's quitting their job first and starting full time, and how long they're going to go unpaid for, all of those sorts of things.
Okay.
Those, you compensate those sort of, I suppose, those leaps of faith, you compensate them for a bit more equity in certain circumstances.
I get that, okay. And then you said something really interesting, which was deciding what happens. I was deciding at that point when you're writing the agreement, the co-founder agreement, what will happen when somebody leaves. So talk about that. What should happen when somebody leaves? Like, what are the options and why might you decide one option versus another?
Well, so I mean, it's a hard. I mean, so this is where lawyers spend their entire lives, right, thinking about what might go wrong, and then trying to document what happens in those circumstances. And this is a co-founder relationship is obviously a long-term kind of relationship to found a business together. So you've got to think about, well, okay, that's great, but life happens in the interim. So things like sort of parental leave, things like sort of what happens if you have an illness that means you can't continue to work in the business. So there is a lot of different sort of variables within that. And what you'd normally do is sort of try and work out, well, if somebody just decides I'm quitting, I'm out, for no real reason, then in those circumstances, you probably wouldn't want them to keep their equity.
At all? None of it?
Right? At all.
Cheekers.
So that.
But what about the years? What about the years they've put into it? So say if they leave after 3 or 4 years and they've put 3 or 4 years and they were instrumental in building that business, why wouldn't it be fair that they keep some equity?
Well, so in those circumstances, what you would then do is you'd kind of negotiate and agree what's called a vesting schedule, right? So it compensates you over a period of time. It sort of says, well, and this is quite normal, when you get onto things like options, which we might talk about later. Mm-hmm. But that you'd sort of say in the first year, nobody vests anything. After that, you then start vesting your shares in a kind of, whether it's 25% a year. So you're kind of saying, well, over a 3 or 4 year period, you will vest, a certain proportion of those shares. And so you would get to keep a certain proportion, right? If you left in voluntarily. Now, if you did something wrong, so you did something that was really naughty, like I don't know, you had your hand in the till, or you kind of
sure.
you were fired for gross misconduct because you were saying terrible things about the business. In those circumstances, you should lose all of your shares,
yes,
right? Because you've done something that's potentially damaging to the business, and so therefore you shouldn't keep them. But what you've got to be very careful of is investors at a later stage take a really poor view of what's called dead equity. So people who aren't contributing to the business but have shares in the business.
And a significant share, you mean?
Yeah. So that you've got to factor that in, right? And I think that it's a tough discussion, but you've got to try and have those. And if you can't have those difficult discussions at the outset, then is it a partnership that's based on sort of the right values and principles to start with?
And sorry if this is a stupid question, but say you're the principal co-founder, you're the person with the 60%, right? And is it the other person whose shares are vesting? Do you already have that 60%? Because somebody has.
Well, again, that's a conversation. So I would always, if it's two co-founders, I would always, and they both have different skill sets and they're both going to contribute differently. You've kind of got to, you can't really have a one-way vesting or a one-way sort of exit provision, because it needs to be fair and it needs to be balanced.
Okay, so both people have to,
and that is then a disincentive for people to leave if you think about it.
Yeah. Okay, that's true. Okay, so imagine we get our co-founder agreement right up front. Now, why haven't we done this using AI at this point?
Well, I mean, you can definitely use AI, but AI, in terms of the way that we currently are sort of experimenting with AI quite a lot. It's only as good as the prompts and the information you're feeding it.
Yeah.
And so the sort of, you can ask AI to, create me a co-founder agreement. It'll probably generate, a very good draft of something, but it's not going to ask you the questions that you don't know. And it's not going to come up with a solution for a commercial debate between you about who should get the right percentages, what does the lever provisions look like, what's vesting. You can say, well, this is what we think, having trawled, all of the model and whatever the inputs are to those models. And the other thing about AI you've got to be very careful of is a lot of it is based on, if you think about the two largest, Anthropic or OpenAI, they're both US based, right? So a lot of what's going into the model to train it is US law, which is completely irrelevant for an English business, right?
Okay.
So there will be norms in America which won't be the same here, and so yes, and it's the same. It's the same with you can download stuff from the internet as much as you like, right? In terms of legal documents, but you're not going to get the advice. You're not going to get the sort of
tailored approach,
the quality of the inputs, or even challenging you in terms of commercially, is that the right thing to be doing, right? That you kind of need that kind of bespoke, sort of personalized advice that you kind of get when you actually go and see a professional.
Yeah.
And I think that, ultimately AI is going to be a sort of support to a lot of founders in lots of different, kind of quick win questions, simplifying things, thinking about supply chain, thinking about how you kind of do things in a faster, more effective way, creating agents that will kind of, review things as you go through. But ultimately, that you're still going to need to interrogate that, and you can only interrogate it with knowledge and understanding.
Yeah. I know. I think that's what people miss is they don't realise that unless you know the subject inside out, you can't do the prompt in a way that's going to deliver something that covers all the bases and actually creates value. Okay, so then imagine these co-founders then have, this is all working, et cetera, et cetera. At some point in time, they want to bring on an advisor, right? Or they want to bring on a board. An advisory board or advisors, what kind of equity should they be looking to share?
Quite a small amount. So again, it goes back to the principles of, okay, so, what value is the advisor bringing? Yeah. Are they, kind of going to, facilitate and enable the business to grow and scale, or deliver some of the plans? Is there expertise that you're buying in that ultimately you're compensating them through equity? But I mean, I've seen some advisors ask for, a substantial amount, 5, 7.5.
Okay. So 5, 7.5,
that's too much in my view. If it's in the sort of the 1 to 2.5 range in terms of overall percentage, that's possibly, acceptable depending on what they're actually going to contribute. And, there may be certain advisors out there who will also want to be part of your round. So actually, if you bring in a significant player in terms of coming onto your board, or whether it's an advisory board or formally onto the board, and they're saying, well, I'd like to be remunerated with a bit of cash plus some equity, but I'll also participate in the round, they may be able to unlock other investors who'll come in as well.
Yeah.
So there's a big balancing act, but I would never, the keeping as much equity in the founding team in those early days is really important, because if you then sort of play forward and you are going to raise capital from whether it's venture capital or elsewhere, you get diluted. And the problem is that you've got to think about, what that dilution looks like. And so it's tricky.
Let's call that out then. What kind of percentages do you want to keep in the founding team along the way at the different stages of investment,
I mean, that's a really hard one. So what I always try and say to them is, listen, in the early days when you're doing your kind of initial kind of angel round, you want to keep control of the business, and that means that you want to have more than 75%. And so what you want to try and end up with is a position in an ideal world where you're never really less than sort of 30%. And that's kind of throughout the whole kind of journey. And if you can keep it above 50%, that's even better.
Right. Okay. And why is 75% a magic number?
Well, so 75% ultimately means you've got super control of the company. So again, it's like, what are the governance frameworks? If you control 75% of the business, you basically, you are in control of the business, and you can't change anything without your consent. The usual rule of thumb is 50% plus is, you've got majority controlled, and majority wins in most circumstances. So as soon as you then go below 50%, then you're not technically in control, although there's lots of legal documentation in terms of the shareholders agreement where you can give you additional rights to sort of negotiate that.
If you're getting value and insight out of the conversations we have with the founders and business leaders on Brand Growth Heroes podcast, then please like, follow, subscribe wherever you're watching or listening to the podcast, whether that's iTunes or Spotify or YouTube, or whether you're connecting with us on LinkedIn or Instagram. It really matters. It matters that you click that button. It matters that you comment. It matters that you engage. We love hearing from you. So write a comment, write a review on iTunes. Tell us if it's making a difference to you. Tell us if you like it. Thank you so much. So let's imagine you're at the kind of the 1 to 3 million and you're bringing on a team and you want to put whatever 10% or 12% aside for employee options and shares. Is that usually the amount they would put by for?
Yeah, I mean, it sort of depends on the type of business and who you're thinking of bringing into the option pool. Normally, the range is probably at very early stage. So the 1 to 3 million, I would say 15 to 20% is a pool size that you would want. If you've got investors who are already invested, they will probably want to make it slightly smaller. And then the other sensitivity is who gets diluted by those options, right? So if you're doing it at the same time as a round, quite often, and again, this gets quite technical, but investors will say, well, the valuation is X on a fully diluted basis. That means that the founding team is basically taking the dilution of the option pool. So you've got to be really careful about some of this stuff. And ultimately you've got to work out what's fair for you and your investors, and also for the option holders in the future.
Okay, can you spell that out a bit more clearly with numbers for people? Because I think
so let's say you've got a valuation on that you're raising. Let's give it some numbers. You're raising $1 million off a 5 million valuation, right? And they say, well, that's on a fully diluted basis. If 20% of your equity is in options, okay, then essentially you've got you're getting a proportion of the amount that you're raising is effectively diluting you as the current founding shareholders. So if we look at the numbers on that, you're saying, well, of that round, 20%, so that's 200 grand is effectively being diluted out of the founding team rather than out of the investors.
Okay, so the investors are saying we don't want our equity to be diluted
by the options.
By the options, okay.
So even if you haven't issued options, and again, this is a negotiation, because sometimes you say, well, I know that I've got 10% of that pool that's already been issued, but the other 10% is for future employees. Mm-hmm. The negotiation there is, well, if we've already issued these options, then obviously that will be diluted because they are going to turn into shares. Mm-hmm. But the 10% that hasn't been issued, well, ultimately that's benefiting all shareholders after the round, so we should all be diluted by that. So that again, it's sort of you need the help and guidance and support to actually understand some of that complexity.
Because if you didn't know that and then you tried to do it with AI, you wouldn't have prompted for that.
Correct.
You see, there's a live example, everybody, of why you need to know in order to be able to use it properly. Okay, that's really interesting. So imagine then what are the other stages? So you've got your employees are coming in and they are getting options that vest when, let's talk about milestones and cliffs and all of those things, whether it's,
sure.
So let's get into that.
Yeah, so what's great about UK investments is there's a great scheme for options, which is really tax efficient, called EMI, stands for Enterprise Management Incentive Scheme. It's approved by HMRC. It's not, it's not totally straightforward. So there's a complexity around having to agree valuations and time periods, but essentially it's super flexible. It's very tax efficient. It kind of means that when you grant those options, there's no tax implication on the employee or on the company. They are very flexible in terms of the scheme itself. So you can tailor vesting. So when they actually sort of technically are entitled to have those options, you can tailor, when they actually exercise. So when they actually can implement those options and become shareholders. And you can also build in performance milestones individually for certain employees in terms of their options. So they're very flexible. The great thing about them is that they, because they're a government-approved scheme, HMRC authorised, when people get to exercise their options, so they have to pay for their shares. Usually, you're able to agree a very low valuation for those options compared to the valuation of the company. And also, when you then come to pay for them, usually you do that when there is a liquidity event, so a significant funding round or a sale of the business. And so therefore the employee basically doesn't need to pay for them. They get paid for through what they would have received as a shareholder, and then the balance they keep. And if they've held the shares for effectively over or the options for over 2 years, they basically get the benefit of what's called business asset disposal relief. So their capital gains beneficial. Business asset disposal relief brings it down to an 18% capital gains tax rate, whereas the standard rate is 24%. So if you think about that compared to a bonus, if you're a higher rate taxpayer, is taxed at 45%. These options, which, obviously there's a risk because the company may not get to an exit, but ultimately they're taxed at 18% currently.
Brilliant. That is a great explanation. Thank you so much. So imagine then you're thinking about your senior management team, right? You're two co-founders, but then you've brought in someone quite early who is your commercial director or has made their way up to be commercial director and head of marketing. What are you giving them in terms of options and a program to vest those options? And what are you giving other people who come on? How do we think about that?
Yeah, so it sort of needs to be tailored for each business. But I would sort of say that if you've got somebody that is employee number 1 to 10 and is sort of instrumental in terms of the delivering the growth of the business, you want to be giving them something that's meaningful. If you've got an option pool of 10% or 15%, you probably want to be giving them, probably 3 to 5%.
Wow.
Like something significant to really incentivize them. But the beauty of these options, right, is, and it goes back to what we talked about with the co-founder agreement, if they leave, the options lapse automatically because they have to be a full-time employee. I mean, there's some criteria around a bit. Basically, they have to be a full-time employee to benefit from them. So if they resign for whatever reason, those options lapse. So that, again, it's an incentive tool to keep them within the business and also to work towards an exit ultimately.
Okay. And I can imagine then that might become difficult if somebody doesn't want to leave because they don't want to lose their significant options, but it's not working between the co-founders and this very senior person. Then what happens?
Well, then you're into an employment discussion around, are they staying or are they going? And ultimately, if what quite often will happen in those circumstances, if it's something a little bit tricky, is that there will be what's called a settlement, right? So you'll leave and they'll have a specific agreement, and then you normally have an agreement as to whether they can retain certain options.
Okay,
but if
so
they retain them, if they do
anything goes.
There's no norm, there's no market, but ultimately, it is an outcome that is possible, that people are allowed to keep options. Mm-hmm. But in those circumstances, those options no longer are as tax efficient as they used to be because you're not an employee.
Right. Okay, that makes perfect sense.
Yeah.
Okay, brilliant. I love working with good people, and what I love about working with Joelson is they really do know their stuff. And that's why I work with them both on the podcast, but both on the mini MBA. I loved understanding how they're thinking about AI in their business, and that they're helping so many other businesses out there implement the right type of thinking and policies around AI in their business. And I also love learning that it's an art, not a science, valuing a company. I hope you enjoyed that. Just a note to say that, I think legal support is a bit like anything. You can do, you can create your own ads. Or you can get someone who's got 20,000 hours of ad creation and creative to do it for you. You can try and design your own packaging, or you can get someone who's got 20,000 hours of packaging design muscle memory to do it for you. And I think often the founders I speak to will say, oh, well, I can just get AI to do that, or I can just work it out myself. But it's not that simple. I think you're underestimating a huge amount of thinking and learning and experience that goes behind it. So, yeah, it's something I've always felt really passionate about. since my days back in Nestle, all the way through Chobani, Strong Roots, and all of the other companies I've worked with. It's really important, whatever the field is, getting an expert and a supplier on board at the right stage of your growth so that you've got someone who's got your back. And that's something I just wanted to share with you. Please share this episode with a like-minded founder or friend. Like and subscribe, and see you next time. Loads goes into the planning, preparation, production, and particularly editing and sound engineering around Brand Growth Heroes episodes. So my first thanks to my tech guru and sound engineer, Jip again of Ballagroove, and also to the rest of the Brand Growth Heroes team who all put in so much hard work to bring these episodes to you.